Okay, well, welcome. So nothing to see here. CPI. I think it's interesting on a couple of levels, and this is just a chuckle I was having to myself earlier on, is that commodities are positively correlated to equities at the moment, and it's like very strong. It's a 0.98. And so people chased equities higher in a rate of change growth slowdown because they expected inflation to drop, but chasing equities higher pulls commodities with it higher, which drags inflation higher, which means that the number comes out higher, which takes equities lower. What? It's tremendous. I encourage everybody to ask questions along the way here, and it helps me sort of gauge of the level of interest, what we're talking about, okay? So, all right, so I want to talk a little bit about volatility and the spillover effect that that has in the market at the moment. Now, those of you that listen to my webinars on the regular basis, you'll know that I have a very simple recipe for trading the dollar. And we went bearish on the market. We went bearish on the market in late December, and then it really sort of manifested itself to begin the year in January. And here's the thing, and I know this is FX Street, but I want to talk a little bit about all sorts of cross-correlated markets. And the dollar is probably the simplest macro trade going and has been for a long time. All right, anytime that you have, and we'll talk about the thesis for this, but you guys know that I like to sort of break the macro picture up into four sort of stages. So one would be the inflation. So I'm going to put I for inflation. All right, inflation down, and we'll put growth up. Okay, and then the other phase of the economy, and these cycles last for long periods of time, and a lot of this is contingent on base effects for the phase of the economy we're going into. Okay, number two would be the reflation phase. So this is inflation up. This is inflation up and growth up. Okay, and then the third possibility that we can be in is stagflation, where we have inflation up and growth down. And the phase of that we're in right now, deflation, is inflation down and growth slowing on a rate of change basis. And I keep using the term rate of change because that's what matters. It doesn't matter, if non-farm payroll comes out at 250,000 and they were expecting 180,000. Is that a sequential slowdown relative to what it was? That's what matters. I cannot stress that enough. It's on a rate of change relative to itself that matters. If you can take anything from this webinar, take that. All right. So I like to have a macro framework and then boil it down from there. So that's what we're going to do today. All right. And we'll move along kind of quickly, try and alleviate some boredoms. All right. But at the moment, what's interesting about all of these, and so we had this going on for the most part in 2021. All right. And the end of 2020 after the COVID, they spilled 7.2 trill into the market, and we had rampant inflation and rampant growth. And this is where we had all the meme stock garbage and dogfood.com going up 1 million and crypto going berserk. Okay. And the interesting thing about this phase where we have inflation down, growth up, and what we had in beginning of 2021 and the end of 2020, and also even in stagflation, is our friend the US dollar goes down. Okay, so for me, FX is literally boiled down to this. In all of these periods of the economy, the dollar goes down. However, when the market's discounting, basically, I call it deflation, but it's essentially a market correction, crash, whatever you want to call it. This is the only period of the economy the dollar goes up. All right. And guess what? The models are saying for the next 3 quarters, we got this. So we just keep buying dollars and, you know, the European economy is in rough shape. So the best trade in macro remains shorting the euro against the dollar. I mean, it's literally that easy. And we've been saying this since January. So, you know, how do we determine this rate of change slowdown? How do we determine what phase of the economy we're going into? Right. So this is where I like to use a combination. One, obviously, we measure and map the economy. So picture a person on a trampoline and they're in their backyard. Okay. And this is the trampoline. This is the person. Okay. And they got a smiley face. And they're jumping up and down on this trampoline. All right. And they jump as high as they possibly can. And let's say the height of that jump is 2 meters. All right. And they at the 2 meter level, and mom comes out the house and says, jump higher, Johnny/Susie. And he goes, oh, but I'm already jumping as high as I can. Well, he's likely then to jump less high on a rate of change basis. So the next jump he comes down, unless somebody comes and double bounces him on the trampoline, he jumps his next jump at 1.8 meters. Okay? A rate of change slowdown. A rate of change, but still very high, but a 10% less high relative to this previous one. So this is the base effect of how to measure and map your macro picture. And it's the same thing for corporate growth. It's the same thing for corporate profits. All right. So as of yesterday, we were at, even after a 23% drop in the NASDAQ, we were still at about 19x on EPS. Okay. This is a bubble high going back a century after a 20% correction, mind you. All right. So the point is that we have a long way to decelerate relative to what we were on a corporate profit basis, on an economic growth basis, and an inflation basis. And what's happening is that we have the Fed tightening into this. All right. So a couple of things to consider is that I'm going to refer to the American economy here just as a proxy. And by all means, fire off any questions you have as we go. There's something to think about is that the refi rates have absolutely plummeted. Why? Well, because for most people, they bought or refied homes in the last 5-6 years. Okay, for a lot of Americans, they take on a lot of debt. All right, this is something that bends the minds of those in the rest of the world, but this is what we do. We take on debt, we buy stuff, and we export paper money that we've printed up to the rest of the world. And we call that a success. All right, we can talk about the merits of that all day, who cares? And then what we do is we take this money, we buy stuff, we build houses, etc. But what's happened is that the mortgage rates have hit almost 6%. So the people that had mortgages over the last 10 years, which is a bunch, are now no longer in a situation where they get a preferential rate for refining their mortgage. It's actually higher. So they've stopped refining mortgages. All right. And as a result, we've also had, they've stopped adding on to homes and people are slowing down and buying homes. But that should be extremely deflationary. But the problem is that it's killing the new home building industry. So our new home building has slowed down, and our existing homes are now the primary vehicle for selling homes to people. So we're getting the shrinking supply while we're getting the shrinking supply of homes in a situation where homes should be correcting because less people are buying them. So you're getting this sticky shelter inflation that's causing things to stay high, and that's obviously going to correct itself. But for the time being, that's a thorn in the side of the Fed. All right. Now, the other thing to consider, and this will be controversial, and people disagree with me on this, but politically, and we're going to get to the vol side of this, so stick with me. I just want to give you a little bit of the framework as to, one, why I'm very bearish. I mean, the most bearish I've been in. My picture on FX Street's about 20 years old. I'm considerably older, been at this, and this is the most bearish I've ever been, just because of the steepness of the rate of change slowdown that we're about to go into, and the fact that we have tightening monetary policy into that. And the other underlying issue that people aren't really talking about is politically it's never popular to solve long-term problems, because it doesn't get you votes on the short term. People are myopic. They only see what's right in front of them. And so the demographics have become a serious issue now. What COVID did is a lot of the baby boomers, those sort of 62 to 65, 66, they were near retirement but not at retirement. And what COVID did is it pushed a lot of them prematurely into retirement 2-3 years ahead of schedule. All right. And that was the baby boomer population, particularly in America, was the biggest net buyer of equities and also the biggest demographic component in the United States. All right. Typically, if you look at a non-industrialized country, say Angola, for instance, all right, their demographic will look like this, as a pyramid, meaning the 90-year-olds up here and the 1 to 5-year-olds are down here, and the 35s to 40 are here. Okay, and it looks like this anthill of older people at the top, and the 35s to 40 or 30s to 40s breeding and producing 2-3 kids per house. All right. The US looks something like this. Okay, something like this, where we have the 90s at the top and we have the 35s to 40 in the middle, but then we have, the new working population, the Zoomers over here, the 20s to 30s, and they are considerably smaller than the baby boomers had 60. And so these guys are all retiring, and these guys are meant to be filling their jobs. But there's not enough of them. And these guys here were mostly, obviously, they've worked their whole lives, then more leadership roles. Okay. But even then you have the Gen Xers trying to fill those leadership roles, but there's less of them. All right. So in the US, just because of demographics, we face a 400K per year worker shortage. And it's going to grow to 900K per year by the year 2034. Oh, but David, why don't we mitigate this with immigration? Well, where are the immigrants going to come from? Europe is faced with the same thing. China is even in a worse situation. China industrialized so quickly that what happened, America's demographics are actually not as bad as China, Japan. These countries that industrialized very, very quickly have seen absolute catastrophic fall off in their birth rates. And what's happened there is because they industrialized so quickly, the people moved from, farms and rural agrarian activities into urbanized households. And what happens when you put 4 or 5 people in an apartment complex the size of a shoebox? They look at each other and they want to throw each other out the window. The last thing I want to do is start breeding. And as a result, you have a birth rate that collapses and your demographics get upside down. And now all of a sudden you have expensive labor because you have a shortage. And, this happens geographically. So you can't really import people. The same thing, Americans are deathly afraid of Mexicans coming over the border. Well, Mexico has the same problem. So we'd have to go further south into, Southern America or Central America or even South America. And it's exactly, Chris. So Chris is saying, Canada faces the same sort of thing. Yeah. And this is a serious problem. And what's happened is it was a long-term problem that nobody cared about politically because there's no political value to solving these sorts of things because they're long-term issues. Why should I worry about it now if it's, 2 administrations times problem? Well, the thing is now we have this problem in front of us. And, a lot of this stuff is, a lot of the baby boomers were in the trucking, transport, and logistics business. And so they have basically parked their truck. This isn't a business that you can easily fix or mend. There's a lot of moving parts. This isn't an end-to-end sort of business. This is an end with 5 stops in between type of business with lots of moving parts. So we got this, and I know it's controversial, and this, people will disagree with me on this, but labor shortage is sticky inflation. And so we've got this cost push inflation, which I know is controversial, meeting the excess that we had from a lot of central banking. We can get into that. But the bottom line is we are in a serious growth rate of change slowdown. And that means for us that the best asset allocations, and I know gold has underperformed, but typically has been fixed income. We have rising interest rates. We're going to talk about that. Gold and the dollar. Okay. And the best shorts in this are tech, industrials, financials, and discretionary. All right. And the best longs have been and will continue to be staples and utilities. All right. So for our economic framework, what do we have to remember? We have to remember buy dollars when it makes sense, and we'll talk about that. Sell tech, sell discretionary, and no offense to those of you in Europe, but Europe is a tough place to have your money at the moment. And so some of my favorite shorts there are Italy and Germany. All right, EWG, EWI, for those of you in the ETF world. All right, and then we can buy against those shorts, utilities, healthcare, staples. All right, so how do we put this puzzle together? All right, now I like to watch a couple of things. As a general, so before we get into it, so let's keep this in mind. All right, so our longs are XLU, XLP. Okay, our shorts are QQQ, growth basically. Small cap stuff, RWM, some high yield debt. You get the idea, right? All the high beta, HYG, sorry, that is terrible writing. All the high beta stuff, those meme stock garbage, all right? Non-profitable growth companies, basically, all right? And the best long in macro is the dollar. Okay, and our shorts here, I'm going to put Germany in that, EWG, and say Italy, EWI. Okay. And based on the year that Ferrari has had an F1, that applies. Okay, so right, so this is utilities, This is staples. This is QQQ. So QQQ is basically tech. Okay. IWM is the Russell, small cap growth. Okay. HYG is high yield fixed income. EWG is Germany. EWI is Italy. This is more approachable for us in America to trade around. I know it's not glamorous, it's less leverage than in the futures, but this is what most of us have access to. Okay? And then the longs would be the dollar. All right? So this is our basic framework, and we're expecting deflation, which means inflation at the moment very slowly going down, and more importantly, growth tanking. Right, now, I like to look at the VIX in 3 formats. Okay, number 1, 14 to 19. Okay, this is the bullish side of the market. Stocks are going up, everything's calm, Apple's catching the headlines. It's a certified monkey can make money in this environment. All right, then we're in a little more of a mixed bag, 20 to 27, 28. All right, this is more high volatility, choppy, you know, up 2% one day, down 3% the next day, massive bear market rallies, massive bear market dumps. This is this regime. All right, then we into the buy nothing. It is a death trap sell-off. That's this regime, the 28 to 37. All right, now, in here, in our 14 to 19, this is generally that inflation going down, growth up scenario. All right, and this is where basically we want the opposite allocation as we see here, shorting dollars, buying growth, buying tech, you know, shorting fixed income, you know, equity exposure, high beta stuff, etc. Right, we are not in this right now. And if we say broke below 1918 and sat there for 2-3 days, we talk about the VIX, yes. Sorry, VIX. Yes. Okay, if we broke below that and sat there for a few days, the market would be going up considerably. But I would expect us then to push down to 15, 16. All right. And we then have to consider that we're going into a different phase. A lot of times the volatility regimes will actually lead what's happening economically. All right. But here, let's talk about this because this is what we're in at the moment, 2027. Now, when we head towards 2027, obviously yesterday we had vol up with equities going up. That hasn't happened in a very long time, and that's not bullish for markets, by the way. That is people hedging like you won't believe. All right, and realized vol and implied vol and different things. We're not going to really get in that discussion too much, but anyway, we will here. And I want to talk a little bit about passive flows and what they mean for the market, because that's a whole new thing. The options market's now bigger than the spot market, and we've got gamma and vol targeting and a whole bunch of things to consider as well. All right, so now as a broad, and this is way oversimplifying, when do we want to put on the majority of our shorts? Well, when we closer to 20, 21, 22. So that's when we'll go over here and start picking our favorite one of these to short. And when do we want to offset some of those? We always want, in a deflation run, we always want a core of these. We're not necessarily holding a core of the longs because we're expecting a stock market drop, but we always want to hold a core of these shorts. And then when we're at 27, which is a stock market sell-off, obviously, we're going to then start to take on a little more risk here. And this is how we're going to balance this short selling, quote unquote, portfolio. All right. And what we're going to watch in between then, as far as the dollar, is, are we seeing positive correlation with equity market when the equities are rising? So over the last week we have. We saw euro going up, pound going up, while the equity markets went up. So we can use the equity markets as a proxy for when to look for opportunities to sell euro and sell pound, or at least sell calls against them. So then we're picking up a premium. And if we get called, so let's say, pound goes back to 1750 and we sell, say, 119.50 calls for a month, we might get a decent premium on that. And if we called, in other words, put short at 119.50 or 120.50 in a month, we don't mind. Because one, we would have collected the premium, and two, we don't mind being short there anyway because we're in this deflation regime, so we like being dollar long anyway. Okay, that's a nice way to catch some premium, but also potentially be in trades we want to be in down the road with limited risk in between. I hope that makes sense. All right, so the other things I like to look for here, let's say we're at VIX 20. Okay. And I'm looking at the DAX, I'm looking at QQQ, and I say, yes, I would like to short some of those things, and I would like to short our euro because it's at 102.50, which is the level I like. Right. Then I will go and see what the options market is doing in terms of, are we showing a implied volatility discount or premium? If we are showing an implied volatility discount, that is favorable for a short. If we're showing an implied volatility premium and I want to short, that'll make me wait until there is a discount on that. All right. But that's a different discussion. So let's look at an example here. Oh, one other thing while it's on my mind is the crypto goes up in reflation, it goes up in stagflation, it goes up in that Goldilocks period where you have growth going up and inflation coming down. Crypto doesn't do well in deflation, guys. And I mentioned this in January, and I even said we have an awkward conversation to have when ETH was, still at 5,000 coming off 6 because that puppy was going to get cut in half, and we're even below that. So if you are investing in crypto in a vacuum, I would highly encourage you to rethink that. We really do need at least a stable growth platform for crypto to go up. It's basically a high beta. It's the expression of, a high beta growth stock, basically. All right. And you've got to remember something as well, guys, is we have something called vol targeting in the world, and it's responsible for about 7 trillion a year in passive indexed assets. All right. So let's say that you are a 40-year-old person, you go to your financial advisor and you say, I want to retire at 65. You will likely, that money that you invest will very likely go into what they call a target date fund. So in other words, it'll go to Vanguard, it'll go to BlackRock, and they'll put you in a target date fund that says you got 25 years to retirement. All right. And what that means is that it's a volatility targeting fund. In other words, when you're younger, you can take on more volatility to achieve more growth. But the older you get, the less volatility you can take on in your portfolio. Okay. So let's say, and I'm going to use an arbitrary number, let's say that you in a vol targeting fund of vol of 10. And I know it's an arbitrary number. And let's say you're a young person, you go into a vol targeting fund of, say, 20 is acceptable, meaning higher. Right. Now, crypto is starting to get owned more and more institutionally. Okay. But let's say that part of your asset allocation is, say, I don't know, we'll do this for arguments. I'm trying to simplify it. Let's say your crypto allocation is 5%. All right. And, for argument's sake, it's in Bitcoin. And for the time being, Bitcoin volatility is, say, and we can do this on a Z-score. We can do this. I'm just going to do it, say, relatively speaking. Let's say it's relatively high, 15. And I know these are arbitrary numbers, but it'll make sense in a minute. All right. Now, let's say that we have a growth surprise to the downside, and Bitcoin sells off to 30. Okay, meaning its volatility goes up double. Okay, now you have a 5% allocation of Bitcoin in your target date fund. So in other words, what I mean by vol targeting is they have to target a level of volatility in the fund, meaning that they have to buy and sell relative to what the overall volatility is of the fund. Okay? Does that make sense? So in other words, if stuff starts to sell off, they have to get rid of it exponentially quicker and into safer assets to maintain this target they have. All right. So if Bitcoin goes from 15 to 30 and your asset allocation is 5%, even though the asset allocation might drop to, say, 3%, the overall volatility of the fund goes up quite a lot more because you're carrying the super high beta asset. So what's the first thing you got to get rid of? One, you got to get rid of the thing you can get rid of, which is liquid, generally. And that's, in my mind, what gold's been going down. It's also been a product of the dollar strength. But you got to get rid of the most volatile asset you have, which is this one, to maintain this vol target. So you start dumping it. It doesn't matter what the story is. It doesn't matter what Metcalfe's law is and what this altcoin is. Institutional people with vol targeting have to get rid of it. Does that make sense? So if you're investing in crypto without a macro framework, that's a tough way to do it. And this accounts for a lot of things. So, these vol targeting funds are responsible for 7.2 trillion a year. All right. And we have models for tracking that stuff. The other thing to consider is the options market has now become bigger than the spot market. All right. And let's say that you are buying a put. Okay. 30 days out. You send that put off to a dealer. There are two primary dealers in the world. One is called Citadel. The other one is called Susquehanna. Okay. And they control about, I'm not lying to you, $3 trillion worth of options every day. All right. Now, our options expiration that is about to roll over now is at $2 trillion, one of the second biggest one in history on Friday. All right. But now these dealers have to be what they call delta neutral, meaning that they need to hedge that options exposure because they're not interested in taking a directional bet with your option. That's your department, isn't it? They're interested in if the option is exercised and being able to honor that option. Okay. And that difference between the premium and what they're going to honor it at is called, the difference or the delta. Okay. And that sum of money is called gamma. Okay. All these Greeks, whatever. But they need to hedge this quote unquote gamma exposure. All right. Now, how do they do that? When they're in negative gamma, what happens is that the market's generally dropping. Okay. And these dealers have to sell futures. They have to chase futures lower while the market's dropping to be able to be delta neutral on their options exposure. Okay, so I like to watch options gamma too. So this is a free resource, Tier 1 Alpha, by the way. And here is an options chart or a gamma chart, okay? And we've actually just gone back into negative gamma. So this implies higher volatility, lower volatility. So I like to watch our gamma exposure for higher and low volatility regimes. Because what happens is that in negative gamma, dealers have to chase futures lower to be delta neutral. And in positive gamma, they basically have to sell futures as they go up. Okay, and check that. They have to buy futures as the market rises. And what that does is bring down realized volatility. And this is why we're getting these crazy bear market rallies, crazy bear market sell-offs is largely a function of gamma and tracking these gamma flows. Because if you figure Citadel is transacting at trillions of dollars a day directionally with the market, that can get serious quickly. Make sense? So we got a lot of things to consider these days, not just what's in front of us. All right, so let's lay out a possible scenario in our last 4 minutes here. All right, let's pick the euro. All right. I hope this has made some sense. I know there's a lot of moving parts and a lot of you are probably like, I don't really care about all these extraneous things. You probably should. It's just the complex world we live in these days. All right, so here's our euro. Okay, and we'll go to a weekly, the low-hanging fruit. What's been the trend? Well, bearish. What's it likely to do? Bearish. There's at this point, there's no real reason to doubt it. So let's go back here to our daily. All right, now we're making a series of lower lows and lower highs, but we also have made a higher high with respect to this lower high. So it's not inconceivable that we come down to support and actually bounce up a little bit higher before continuing, or at minimum consolidate based on this. Because a lot of people will be looking at that and say, well, that's a higher high. That's pretty bullish. Well, this downtrend is still very intact. And honestly, until we break form at least one higher high and higher low, it's this bear market. We don't need to doubt this here on the dollar. And this is actually the one thing that's kept me pretty sane on the equity front is, we've had a huge rally in late July, August. Very tough to hold any level of shorts on equities, but the dollar didn't lie. The dollar's been just down. Or up rather, down on euro. So this is still the best trade in macro. Anyway, so let's say hypothetically we get sort of something like this. All right, we enter the traffic here. She comes down towards 99. It bounces all the way up, and we get to say 101.50. Right, and at the same time, we have got our VIX here. Okay, we have VIX that are doing something like this. And it trickles down to say 21. All right, and we start to see, so you have euro up towards 101.50 and the VIX, and I'm just playing out a possible scenario, and the VIX goes down to 21 and equity markets bounce, the S&P recovers, potentially back to say 42.10 or so, and this is what we're looking at. All right, and we had a lower high. This to me would be a pretty ideal short setup, providing we saw on DXY an implied vol, all right, implied vol discount, all right. That to me is a nice euro short and QQQ, etc. All right, ideally what I'd like to see in a perfect world is this steps up a little bit and we get back closer to sort of 102.50 and 102.50 and 103. That takes us much closer to the resistance. But what I'm saying is the conditions for setting up the short can happen lower than that, because then what's going to happen is effectively we're in this consolidation and we're just forming a flag down. So these are some of the things I'm going to be watching. These are some of the things I'm going to be watching. Ideally, 102.50 to 103 is a nice short zone, and I think that we're going to 90 cents, maybe further. I don't really care, but you know, rebuilding the dollar short or rebuilding the euro shorts somewhere between 102.50 and 103 makes sense for, I think, 1,000 pips. And it's the same sort of setup. It's the same sort of setup for pound. And you know, the way that this is played without being in the spot market is, you know, let's say we get to 102.20, then you sell a, say, 103.50 or 104.50 call. All right, let's say you get, I don't know, depending on your size, 500K, three grand, say, then that buys you 50, 60 pips. And let's say in a month it's up there and you actually get called on that and put short here. We don't mind that, because then we've collected the premium and you're in the short where you want to be in the short. That's a phenomenal way to play this sort of long-term macro trades while double dipping a little bit on the options, as well as potentially being put short where you want to be put short on the stock, or rather on the spot side. Okay, so I hope you learned a little something today. We're out of time, but macro framework, watch your volatility, keep an eye on. I'm going to put, if you want that vol-related newsletter every day, I'm going to put the website in here. Why? It didn't, no, whatever reason it's not typing. Okay, never mind. Never mind. It's tier 1 alpha, TIER. You guys can look it up. Anyways, thank you guys. Thank you, FX Street. I hope you picked up a little something. You can reach me on the twit at ForexDavid, FOREXDAVID. And we'll see you in a month.